My name is Victor Otieno. I'm the Managing Director at Vifa Consult, a startup and MSME policy research think tank based in Nairobi, Kenya. Today's session, we ask the big question: is there enough funding for Kenyan startups? The Kenyan innovation ecosystem for the last number of years has raised the banner of the country, punching above its weight and recording stellar performance on many fronts, such as the Global Innovation Index, the Startup Ecosystem Index, and most importantly, venture capital funding. The Kenyan startups have reportedly secured around 82.3 billion Kenya shillings, which is around $638 million in the financial year 2024, propelling the country to the top position in Africa, with the performance driven by sectors such as climate tech, with companies such as Delight, Sun Culture, and Basigo featuring highly in terms of investment. So these deals have contributed to 88% of the total funding raised in East Africa and 29% of all funds raised across the continent. So this continues to be mind-boggling if you think about it critically. Nairobi County government's annual on-source revenue ranges between 3 billion to 12 billion at most. So you can imagine Kenyan startups raising 82.3 billion, and the capital city of the country is collecting 12 billion. So that's food for thought. So the big question here, I think, and we are getting more questions than answers, is from two categories. Number one is from a policy perspective. So what is the implication of this or from a policy perspective? And number two is looking at it from a private sector perspective or private sector investment perspective. So starting with the first category of people. So these are legislators, these are policymakers at both national as well as county assemblies. There are certain questions that they are asking themselves currently for them to be able to understand the startup ecosystem and, of course, establish a supportive policy and legislative environment. So if Kenyan startups are doing this well in terms of funding, so what is the impact, or where is the impact of these funds, at least from a socio-economic development perspective? So three questions that policymakers and legislators are asking themselves. Number one, are these funds showing up as more employed people in these startups? Meaning that as these startups and others are fundraising, are we seeing more Kenyans being employed? Are these funds showing up in terms of tax paid? That's the second question. So meaning these startups are top taxpayers, either from a medium or large category. Number three is the economic output of these startups as well as others in terms of GDP being captured in Kenya's economic review. So if you are to look at the 2024-2023 economic review, are we seeing the economic output of these startups as well as others? So these are three questions that legislators and policymakers would ask themselves as they think about establishing or developing a legislative as well as a policy environment that can be able to support these startups as well as others. Another big question that lingers in my mind is, why is it that local investors have not thrown their hats in the ring if Kenyan startups are doing this well? Two areas that I think I'm trying to think about or to analyze is looking at the Nairobi Securities Exchange, specifically the Growth Enterprise Market segment or GEMS, a segment for small and medium-sized companies that has not been doing well. So this particular segment has not been doing well. It continues to experience a listing drought. And the assumption would be that this would be the platform that startups could exit from. Because one of the challenges that we see in the ecosystem is we are not seeing exits. So, an exit meaning that an investor is able to buy or to invest in a startup at a certain valuation, and maybe as the startup grows, in terms of turnover, the evaluation increases, and the original or initial investor can be able to offload their shares and, of course, get some capital gains of sorts. So this particular segment has not done well, so which, of course, begs more questions than answers. The second area in terms of local investment, or the lack of it, is looking at retirement benefit schemes. So historical asset allocation for retirement benefit schemes over the last 5 years, focusing on unquoted equities as well as private equities, where I would assume startups would feature. So unquoted equities for retirement benefit schemes over the last 5 years has been 0.3%, despite a 5% maximum allowable allocation. Private equities has been getting 0.1% against a maximum allowable allocation of 10%. So majority of the funding allocation by retirement benefit schemes has been towards government securities at 41%, quoted equities at 17%, immovable property at 18%. Again, more questions than answers. Why is it that these particular funds are not allocating even at least at the maximum allowable based on regulation? So I think while the increasing volume of venture capital to Kenyan startups is most welcome, I think there's a dire need to unlock local capital to enable systematic growth of startups across other sectors outside of the prominent sectors of fintech and renewable energy. So we are seeing other startups in other sectors experiencing a funding winter or a funding drought of sorts. Looking at startups in health, in space, in education. So we are not. If you're to think about it, a lot of this venture capital is looking for very quick payback period as well as very high return on investment. So possibly maybe fintech as well as renewable energy, climate tech is the in thing, and maybe they are able to tick those boxes. But you can't develop a country by focusing on one or two sectors only. So I think there is a dire need to unlock local capital, which I think is potentially significant. So as I conclude, I think the Kenyan government, through the respective ministries as well as entrepreneur support organizations and development partners, must focus on 5 key things. Of course, there are many others, but I think these are the top 5, if you may call it that. Number 1 is reducing the risk profile of startups through a guarantee scheme of sorts. Number 2 is educating local investors to understand and appreciate the high risk and high reward nature of startup investments. Number 3 is establish a supportive policy and regulations to startup investments. Number 4 is fiscal or tax incentives to private sector to support startups. And lastly is affirmative procurement opportunity for startups with ring-fenced funds to avoid pending bills. So, of course, someone would say we already have an affirmative procurement in terms of AGPO, which is the access to government procurement opportunities. But if where it is mandated that 30% of government at both national as well as county is provided for youth, women, and people with disabilities. So I think we specifically need an affirmative procurement opportunity for startups, given that the current, maybe for example, administration is focused on digitization. So I think there's an opportunity for startups to be able to help government in terms of digitizing. And of course, the startups can be able to get funding through revenue by giving government the service through development of digital products. And of course, the issue here is ring-fenced because you can be able to get an opportunity in terms of procurement, but it doesn't help if you're paid after 1 year or 2 years. So the money has to be ring-fenced to ensure that once the startup has delivered, they're able to access these funds. So that marks the end of today's session. I hope that it has been helpful to you. Let me know if you think of other SME as well as startup topics that you think we should talk about or tackle, so that, of course, we can be able to enrich and be able to educate as well as enlighten different players within the ecosystem. So you can share your feedback through our social media pages at Vifa Consult, at SME Biz Hub, and possibly we can be able to continue this conversation. See you in the next one.